Hello, investors. Welcome to the podcast for the month of February. In this podcast, we'll discuss the big announcements made in the budget 2023. How does that impact various sectors, asset classes, and how you should craft your portfolio to take advantage of it? And does that alter in a way how you make your investments? So overall, the budget was positive according to us. There were many positives built in, but we think that it's a long road approach. So let me give you a backdrop. What we were seeing earlier was that government did the heavy lifting in the economy post-COVID, did a lot of capex, which led to demand boost in the economy, and that led to capacity utilization increasing, and therefore led to the private capex green shoots in a way. So overall, that was the cycle that we saw over the last couple of years. Now, governments again sought to do the heavy lifting and do more capex rather than boost consumption. If they had boosted consumption in a way, that could have led to more private capex coming in. But here again, they have sought to do capex themselves, leading to increase in consumption through boosting of employment and incomes. And therefore, over a period of time, again, demand for things increasing in the economy, which will lead to more capex from the private enterprises. So we think it's a long road rather than boosting consumption. They have stuck to more capital expenditure. So it's heavy on capex, which is needed in a way to ensure the cyclical recovery. The union budget has sharply stepped up the outlay for capital expenditure to 10 lakh crore in 23-24. This is about 3.3% of the GDP. So the capex is more heavy on infra. So like railways, it's a 2.4 lakh crore allocation. There are 15 new airports to be built, and clean energy also had an allocation of 35,000 crores. So overall, last few years, we are seeing that increase in capital expenditure by the center, and which was around 1.5, 1.6% of GDP, has now reached 3.3% of GDP. So that's a good part that government's thrust is on more capital expenditure rather than populist measures. So what we have seen, again, no populist measures in terms of lower handouts and subsidies. So government has chosen to go with more infra and housing, or things like subsidies and Manrega. Allocation to affordable housing of 79,000 crores, which is increase of 66% from the original budget estimates, which got revised to 77,000 crores in the revised estimates. This will also help the housing market retain momentum. There is also a thrust on fiscal prudence with some tax relaxation for urban consumers overall. So tax exemption of annual income of up to rupees 5 lakhs under new tax regime has been extended to 7 lakh rupees. Besides, the tax slabs have also been tweaked to benefit the taxpayers under the new tax regime. So overall, with maintaining the fiscal prudence, government could only do so much, and they have opted to do more capex or consumption, clearly. Also, we are seeing a thrust on the green economy. So there is National Green Hydrogen Mission, which has an outlay of 19,700 crores. Plus, there is a 35,000 crore of priority capital investments towards energy transition. So what we've seen over years, over the last 5 years, is really expenditure toward environmental activities have increased sixfold. What was 0.08% of GDP has gone to 0.3%, but on absolute numbers, it has increased by sixfold. Even on social activities, we are seeing that it is slowly increasing from what was around 0.7% of GDP to close to 1% of GDP. So how these announcements impact equity markets and various sectors will benefit or lose on account of these announcements. So overall, if you look at agriculture and rural India, subsidies have declined. Both food and fertilizer subsidies. So that's a bit negative for FMCG and auto sector from a demand perspective. From an employment generation perspective, again, allocation to Manrega has gone down. So that's also negative from a demand perspective. But again, it's very, very debatable, because Manrega, if it is lower allocation, which means that there would be enough employment generation activities through capital expenditure, which they would have estimated, and therefore lower allocation to Manrega from that perspective. Again, capex spend on infra augurs well for employment generation, which is the way the government has sought to do. So this is positive for CVs, commercial vehicles, that is, capital goods, construction, banks, and building material sector due to sharp increase in capex spends. Even banks would benefit from persistence of credit demand. Looking at the financial sector, the announcements were removal of tax benefit on redemption for non-ULIP products with aggregate annual premium of 0.5 million plus, that is 5 lakh rupees, and higher adoption of new tax regime could also impact flows into ALS scheme. So it's kind of a bit negative for life insurance and asset management companies. Looking at duty changes and tax changes, duty on imported lithium battery is reduced to 13% from 21%. Also, duty on capital goods machinery for manufacturing of lithium-ion cells has been made to zero. So it's positive for auto and auto ancillary sectors. Battery manufacturers who are aiming at lithium-ion cell manufacturing will also benefit from lower duty. So that's an impact from equity market and sector perspective. From a debt market perspective, I think fiscal prudence will support bond market sentiment. So fiscal deficit is likely to be at 5.9% as compared to 6.4% in FY23. This is largely in line with market expectations. Again, that's been driven by, at one end, we had improving tax collections, improving spending quality, because higher the capex that they do, which will lead to higher activity in the economy and therefore higher tax collections over a period of time. Also, a fiscal deficit, there is again, it was 5.9, and by 25-26, it's likely to inch down to 4.5%. So there is a glide path, which will also lead to lower net market borrowing over a period of time. So what was 4% in 22-23 will be 3.9%, almost similar next year. And it will go down to 2.9% in 25-26. So this augurs well for RBI's monetary policy overall. Tightening cycle could be slowly reaching its peak. So from short-term perspective, less than 1 year investment horizon is, if you have, then probably stick to liquid funds with good credit quality portfolio. And from medium to long-term fixed income allocation, you could look at dynamic bond funds and invest in them in a staggered manner. So only if you kind of understand the risk of a dynamic bond fund and bond markets, you could willing to tolerate the volatility that will come along, you could look at the dynamic bond fund from a 2 to 3 year investment horizon. So while everything is positive, what were the disappointments overall? There were a few. Rural consumption push was not enough, like cut in Manrega and lower food subsidy, lower spending on agri and allied activities. It does not boost consumption, and rural economy has been struggling post-COVID and has not recovered as much as what urban India has done. Second, capex spending will also have a delayed impact, especially in rural areas, so not much support there. And thirdly, on the gold rationalization of gold duty, which was a missing element this time in this year's budget, which could have been a positive for gold market, though it would have led to gold prices dipping, but it could have been overall positive for the gold market's development. So in terms of takeaways, key takeaways. So it's a capex heavy budget, which augurs well for equities over the medium to long term. What are the risks? Is the near term valuation concerns for broad markets that prevail. We are still slightly above the average, long term average. And on a relative basis, we are expensive as compared to other emerging market economies. So there could be an impact if there are disappointments on earnings or growth, or concerns of corporate governance. Second is fiscal prudence is always good news. Is also good news for bond markets. So although rates may remain high until we see inflation dipping, but that could give you higher yields on your liquid fund investments. And if you have a longer term horizon, then that could augur well for your bond investments. Gold still remains a good diversifier in case equity is correct, with having a positive view, of course. So duty cut risk to gold prices have reduced, so maintain an allocation there. So overall, from a allocation perspective, I think in 2023 also the 12-20-80 allocation works well. Uh, Probably none of the asset classes are at extremes. You could stagger your investments and build your portfolio next 3 to 6 months in each of these asset class. So overall, when you build a portfolio, please ensure that you have an emphasis on corporate governance. The recent episodes that we have seen in Indian markets and the impact on portfolios has been significant within exposure that does not have that emphasis. So overall, when you craft a portfolio and have invest in instruments like equities, you need to have a very well-defined corporate governance emphasis. So overall, with that, I think the 12-20-80 allocation does work well for 2023 and beyond. So to invest, and you could stagger your investments and build a good portfolio. So with that, I wish you happy investing, and we will come back next month. Thank you.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.